Everybody, welcome to the Sherman Show. I'm Jeff Sherman here with my co-host Sam Lau.
Hey.
And today we have a returning guest, none other than Dr. Ed, as he's known colloquially, Dr. Ed Yardeni. He's the president of Yardeni Research. They're a global investment strategy and asset allocation analyses, provides a lot of recommendation. He's a well-published author. In fact, we're one of the first people to have him on our podcast to help him promote his new book that he put out, and he sent us a copy of it, and Sam and I would highly recommend that. It's called In Praise of Profits. Very, very timely, Dr. Ed. So thanks for joining us today.
Thank you very much. My pleasure.
Yeah, so speaking about the book too, since we got an early release of it too, maybe give us a little bit of overview. What prompted you to write this? Following on to the last book you read, Fed Watching for Fun and Profit, which we both enjoyed as well as we are Fed watchers. But
Right.
Let's talk about the profit component and what motivated you to write this book today.
Well, profits has been getting a lot of negative press. It's almost become a four-letter word. And I think there's a school of thought out there that the only way that anybody could be very profitable is if they're exploiting their workers or taking advantage of their consumers or getting political influence. And I'm trying to kind of set the record straight and provide a more balanced view of just how critically important profits really are to the U.S. economy. In fact, profits are they're the lifeblood of the economy. They're what creates prosperity. And the logic of it is embarrassingly simple. And that is we can all look around and see that profitable companies over and over again tend to expand. They tend to hire more workers and they tend to expand their capacity and they spend more money on research and development, and they try to come up with better goods and services at lower prices. And then unprofitable companies don't do any of that. They don't expand, they don't create jobs. So if we want to have an environment of economic prosperity, we should provide an environment where companies can be profitable, where entrepreneurs can come up with new products and services at lower prices. I make a distinction between crony capitalism and entrepreneurial capitalism. I'm an entrepreneurial capitalist. That's the system I'm promoting. And that's a system where there's a great deal of competition. And that competition keeps me honest, keeps me trying to do the very best I can for my clients. And it's really a radically different approach than Adam Smith, who sold capitalism as based on selfishness. I'm not selfish. I'm always thinking about my customers. I'm always thinking about, if I don't give them the very best of my work, they'll find somebody else that they'd rather pay, and I'd be out of business. So that's really the point of the book, is that we should really appreciate how important entrepreneurial capitalism is, how important entrepreneurs are, and the thought that it's just sort of a class warfare between labor and corporations and capitalists. That's really not the way our economy operates. As a matter of fact, one of the points of the book is there's all these proprietorships, sole proprietorships. They're S corporations, they're partnerships. These are all so-called pass-through entities that account for more than half of employment in the United States. And as we've seen recently, more and more people are responding to the pandemic by saying, you know what, I think I'd rather be my own boss and creating their own jobs. So we're really a country of entrepreneurs, which is a very healthy development.
Yeah, I wanted to dig in a little bit about that, Dr. Egg, that when you talked about prosperity in America, and I think part of the narrative that you mentioned the class warfare, and it really is just how the narrative is shaping, maybe not recently, but it's reemerged, let's just say, pitting capital against labor, but just the idea of common prosperity, perhaps, in America, and how, if you can just dig in between the relationship between profitability and the overall level of aggregate income, and the idea that perhaps aggregate income increasing and a rising tide raises all ships kind of situation.
Well, I don't like to just throw out claims without being able to back them up with data. And I actually prefer to start with the data and see what the data suggests is the way things work, rather than reverse engineer it and start out with a proposition and then look for the data that confirms it. And I think there's a lot of that going on in our economy, where people are saying, well, we've got a great deal of prosperity, but the average American hasn't prospered at all, that most Americans aren't any better off than they were a few decades ago. I know that just doesn't sound right, but it's said over and over again, and there's claims that data supports it. And there are some data that support it, but there's a lot of problems with that data, which once you make the corrections and the adjustments, you find that it supports the idea that Americans have never been better off. Now, clearly, there's income inequality. Clearly, there's wealth inequality. But one of the points I make in the book is that you always get the most inequality during periods of prosperity. The rich do get richer during periods of prosperity. The poor do better during periods of prosperity, but maybe the people at the top end do better. The other thing we have to understand about inequality and about income inequality and wealth inequality is that some of that's demographically related. I mean, when I was in my 20s, just kind of first starting my job, I wasn't making very much. Now I'm making more. Older people do tend to make more than younger people. And we have a lot of baby boomers who are now just starting to retire, who've done extremely well. And as they retire, we'll find that the previous generations are going to have more and more opportunities to do well. Wealth is something that you create. Wealth is something that takes time to build. And that's why we find that, if you look at the Forbes 400, it's not the same people that we had 10, 20, 30 years ago. And most of them are relatively senior citizens compared to younger folks. So those are some of the points I've been trying to make in the book to provide a more balanced assessment of how our economy operates, and just kind of push back against this negative attitude towards profit, towards success, towards entrepreneurship.
Yeah, so on that note, when you talk about the prosperity-driven aspects of the economy, you make a distinction between the profit-led prosperity, right, which is kind of the point of the book, versus stimulus prosperity and stimulus-led. And so when you think about juxtaposing those two against one another, do they have different implications on the overall economy? And what pieces of that, like, is it more inflation driven if it's stimulus led prosperity, or is it, real growth rates? How do you think about those two?
Well, my preference always is profit-led prosperity, prosperity led by the entrepreneurs, by the business sector, coming up with better goods and services at lower prices. That increases the standard of living of the consuming class. I try to avoid this class conflict notion, and I do that by saying, well, wait a second. Really, in an entrepreneurial system, the only class that really matters is the consuming class. And guess what? We're all consumers. We're the ones who benefit from entrepreneurial capitalism. We're the ones who get better and better goods and services at lower and lower prices. And so I'd rather have that be the source of prosperity than the government constantly try to meddle in the marketplace, try to tell us that the market's not working, that entrepreneurial capitalism is not working, and that we need more taxes and more government spending to make it operational. The problem when you get the government involved is the government really doesn't do a very good job of allocating resources, of managing resources. It gets very political about it because that's the nature of government. Entrepreneurs, on the other hand, are catering to the needs of their customers. And if you give them the profit motive, allow them to enjoy the benefits of their success. In other words, if they're making us happy, that means we're paying them more. And if we don't begrudge them that success, they'll become richer. And some of them will become extraordinarily rich. But you know what? There's a limit to what they can spend. And very many of them, what they do with their wealth is they tend to want to diversify it. So what do? They buy into new deals, they finance new ventures, new ideas, which then feeds the entrepreneurial mechanism of our economy. So I prefer that approach to prosperity than one where it's sort of given to us by the government.
So you mentioned the idea about goods and services getting cheaper, and that's something that we haven't seen really in the last 12 months or so. And we've noticed that, definitely durables have been very strong. We've seen on the auto sector, some of that driving this as well. But there has been this renewed consumption in goods in the last 20 months or so. And we're starting to see that trickle through the inflation data. So services have rebounded as well. So do you attribute that being to more this kind of stimulus-led prosperity at this point, or is this just kind of a kind of replenishing, some change in dynamics that will ultimately revert back to that more services-driven economy?
I think the government overreacted to the pandemic. I think that the initial reactions were fine and worked very well. The Fed came in and did everything it possibly could to avoid a credit crunch. That worked, and they brought interest rates down. They did their quantitative easing, and the reality is that it worked great. And then the fiscal authorities came up with checks. So they came up with the first round of checks last year. Then there was a second round at the end of last year. I think the third round is really what created this demand shock that in turn overwhelmed the supply system. So the supply disruptions just didn't occur out of nowhere. The system was just overwhelmed. As a matter of fact, if we look at the 12-month average of West Coast port traffic, that's something I watch very carefully. It's monthly data. It's at an all-time record high. So we've got, this is, the containers that are coming in that are actually landed and actually being distributed. It's at an all-time record high. So imports are at an all-time record high. And durable goods orders at an all-time record high, and shipments are an all-time record high. So if you really look at the data carefully, what you see is that the demand side just overwhelmed the supply side of our economy. And I think a lot of that was because of the third round of checks combined with an ongoing ultra easy approach by the Fed. Now the Fed is starting to come around and realize that they're behind the inflation curve and are trying to get ahead of it. And that could be somewhat painful, but it just demonstrates that the government can succeed, but it can also fail. Whereas what I think we see with an entrepreneurial system is entrepreneurs are constantly trying to come up with newer, better goods and services, and do that with more productive means of doing so. They want to increase productivity, and productivity really is the source of prosperity. It's productivity allows for wages to rise faster than prices. It allows for profit margins to stay high. And that's really what we want to root for, is we want to give the entrepreneurs the incentive to provide us with goods and services based on more and more productivity, which then allows them to pay their workers more in real terms. It does nobody any good to see wages go up and then prices to go up just as much.
Yeah, sticking with that, the idea of productivity, and in your book, you talk a bit about this your expectations for a coming productivity boom.
Boom, yeah.
What are some of the drivers behind that, and ultimately, what you talked about some of the impacts where perhaps the cost of living type of, there's kind of a cost of living adjustment there with wages perhaps going up, and then the cost of goods perhaps staying the same.
Well, looking at the rest of the decade, the 2020s, it kind of rhymes with the 1920s. So it's conceivable that one possible scenario for the decade is the roaring 2020s. And if that happens, it'll be because there's a tremendous labor shortage. And that labor shortage is not temporary, it's chronic, it's structural. The baby boomers are retiring, and the number of new people coming into the labor market just aren't doing much to replace them. And so the labor force growth is down to like almost nothing. It's down to 0.5%. Whereas back in the 70s, when the baby boomers were just entering the labor market, the labor force was growing 2 to 3%. I think businesses have started to come to realize that the labor shortages are in fact chronic, and that they have to come up with technological innovations that will increase the productivity of the labor force that we have. And I think what's really great about the current situation is it's pretty easy to see all the technologies that are currently out there that already were getting implemented, but because of the pandemic are probably getting implemented at a faster pace. And a lot of these technologies have the ability to increase both the mental and physical productivity of workers. We have to do that. Otherwise, we're not going to have any growth. Real GDP growth arithmetic is really pretty simple. Real GDP growth is equal to labor force growth plus productivity growth. And if we're not going to have any labor force growth, we got to have productivity growth in order to have real economic growth, in order to have wages rising faster than prices, in order to have prosperity. And so that's kind of what I see happening. So if you look back at the 1970s, which is a reasonable alternative to the roaring 2020s, you can see how it could play out, and there's elements of it playing out right now. But the big difference is in the 1970s, productivity collapsed. It collapsed from about 4% down to 0. This time around, productivity bottomed around 0.6% back in 2015. So it's already started to pick up. It's running around 2% already, which is a very substantial improvement in productivity. I see it going to 4.5%, which sounds like, wait a second, that's impossible. That can't happen. But it's happened during previous productivity booms at least 3 times since World War II.
So when you think about that, and the counter argument to that has been the aging demographics, right? The lack of immigration, which is part of your equation in there when you talk about labor force growth. We've seen a lot of kind of early retirement. You've seen kind of the mix shift change of the employed population over the last year or so. And so how does one kind of prevent this idea of this wage price spiraling to offset the wages, right? You've heard anecdotes of some companies raising prices, not just because of input costs, but because everyone else is. Now, again, are those anecdotes, or is that really the motivation? Is it input costs? I think time will tell when we look at margins. But how do you think about rationalizing those kind of two equations together? This productivity boom that you see, plus this just kind of demographic trends and deglobalization. Right.
Well, look, the 2 alternative scenarios that we just discussed, one is the great inflation of the 1970s 2.0, that we get another decade like that with a wage price spiral. And there are similarities. Commodity prices went up back then. Food and energy prices went up back then. But back then you also had very powerful labor unions, and those commodity costs, particularly energy and food prices, went straight into wages, which then created a wage price spiral, because the companies would try to offset that by raising their prices. Now, lo and behold, all of a sudden, we're seeing more strikes in the United States. We're seeing the DEER, which employs 10,000 United Auto Workers, that those workers got a contract where they now have cost of living adjustments. So it's deja vu all over again. So and on the other hand, we have all this technology and all this productivity and labor shortages, which add up to a roaring 2020 scenario. It doesn't have to be one or the other. It could be, for a while, it looks kind of like the 70s. And then we kind of segue into something that turns out to be much better, which is something like the roaring 2020s scenario. But I think it's important that the fiscal and monetary policy authorities take their foot off the accelerator, slow things down from fiscal and monetary side, and let the economy kind of catch up with all the supply that we need to meet the demand. But we have to slow down the demand is clearly one of the ways to deal with the supply issue. But then again, I think companies will respond, and we'll find supply chains moving back to the U.S. We'll find that technological innovations are being used to increase productivity. So I think it's going to be a process. It's not just something that's it's going to be one or the other is the correct way to look at the economy. I think they're both going to be operational. I think coming out of it, we'll find that the roaring 2020s is probably more descriptive than the inflationary 2020s.
So you talked about potentially slowing the demand side of the equation. And so when I hear that, the first thing I think about it is the Federal Reserve, right? And so we're recording this morning here on November 30th. Jay Powell and Janet Yellen are both testifying in front of Congress this morning and create a lot of volatility in the Treasury market in the last couple of days. We obviously have the new variant out there, the Omicron, that's hitting all the news wires and causing a little bit of fear. But also, you heard from Jay Powell this morning come out and say that they may need to accelerate their taper program as well. And so, have you been talking to Mr. Powell and tell him about this demand side, or is this really the Fed being behind the curve? People talk about policy errors and the like. I mean, it's something we always focus on. What do you think about the Fed and where we are in the cycle? And what is your recommendation of what they should be doing, not what they're going to do, but what they should be doing?
Sure. Well, look, I wrote the book that you mentioned, Fed Watching for Fun and Profit, a couple of years ago, and one of the chapters is called Jerome Powell, Pragmatic Pivoter. And I think it's pretty descriptive. I mean, he pivoted in 2018. He was saying that the Fed was going to have to raise interest rates. The stock market took a dive in the summer of 2018. And he said, never mind, just let's change that. And by 2019, by the second half, he was actually lowering interest rates. Then the pandemic hit and he becomes very woke. He becomes very liberal, very progressive, very, concerned about the suffering that people have been going under as a result of unemployment. And he in the summer of 2020, he changes the dual mandate. The dual mandate used to be sort of like a balanced attempt to bring unemployment down and inflation down. What he did is he said, no, we're going to give more weight to bringing unemployment down and be less concerned about inflation. As a matter of fact, we've undershot our inflation target at 2% for so long, we're not going to be terribly upset if we overshoot it. I think recently we saw that the October year-over-year inflation rate that they look at was 5%, and I think that started to get their attention. It's like, that's a little bit too high. It's a little bit too much over 2%. And meanwhile, the labor market has improved pretty dramatically. I know there's been a lot of controversy of whether the federal unemployment benefits kept people from going to work, but the reality is, ever since they ended on Labor Day of all times this year, we've seen initial unemployment claims drop below 300,000. And in the latest week that we have data for November 20th, there's 199,000. So it certainly is consistent with people going back to work. And it's easy getting a job because, as we know, people are quitting jobs. Meanwhile,
look at the quits rate, Dr. Ed. I mean, look at, the quits rate over 3%. You're seeing a lot of the surveys say that jobs are plentiful. You're seeing also the Atlanta Fed puts out a great wage tracker as well, Absolutely. But they also show people who switch jobs, and you're seeing that they're trying to get that improvement in their wages as well, right?
Jobs make more money.
Right.
And that's one of the reasons to switch jobs. So that the labor market, in other words, doing great. And we're taping this, we're recording this before the November employment report, which will come out in early December. And then about 2 weeks later, the FOMC meets. I think the next employment numbers are going to be very strong, given what I see in the initial unemployment claims data. So it's mission accomplished. The Fed wanted to get the unemployment rate down. It's gotten it. It's gotten a very good labor market. They want to get inflation over 2%. It's overshot it. And now they're realizing they're behind the curve on the inflation side. And they're starting to say, well, now we have to think about tightening. And as that dawns on people, that's going to create volatility in the stock market. I don't think it's going to lead to a recession. And I think we're going to be pleasantly surprised the extent to which inflation can come down. Already we're seeing oil prices taking an absolute dive. First, they did it on Friday when we first learned about the new variant of the virus. And now, as a result of the Fed chairman's commentary, we're hearing that the price of oil is down again substantially.
Yeah, and perhaps a piece of that could be the release of the Strategic Petroleum Reserve, but I really don't think so. I think that's just more jawboning than anything,
I
right?
think
And the
it's 3
timing
days.
happened to coincide.
Yeah, it's 3 days worth of consumption.
Consumption at best, right? And you look at
Right.
global oil prices. So
Yeah,
I'll fade that idea too, Sam. Yeah.
yeah, it was
A lot of jawboning there.
it was almost like an embarrassing move on the part of the administration. But clearly, just the the Powell pivot away from unemployment towards maybe we got too much inflation now is having a tremendous impact on bringing the price of oil down, and that's usually a pretty good inflation indicator.
That's right. So one of the things that have come up in this conversation a bit is just the idea that the Fed is perhaps behind the inflation curve and maybe realizing it. But on the devil's advocate side, I mean, does the Fed have some incentive to keep inflation hot? Because one of the things that we haven't touched on yet today is just the level of federal debt that we have, not only here in the U.S. but in central banks across the developed market world. Where just the debt to GDP ratios are on the climb up again to the point where they're getting back to the World War II levels as well. So is there incentive to let inflation run hot a little bit and inflate this debt away?
Well, I think there is. There's also related to that an incentive to be behind the curve, because if you meet the curve or get ahead of the curve, what that means is you're raising interest rates, and maybe raising interest rates a lot. If you do that, then the compounding effect on debt, generally speaking, not just federal debt, but all other debts, gets to be a real problem for the economy. So it's going to be kind of tricky here. They clearly are signaling that they are concerned about inflation. I think they'd like to jawbone it down as much as they can, because the last thing they really want to do is do a Volcker 2.0. Remember, we just talked about the great inflation. 2.0. Well, the great inflation was the 1970s, and the way that finally came to an end was Volcker came in and just smashed the living daylights out of the economy by letting interest rates go to whatever level was necessary to cause a recession, which brought inflation down. I mean, one of the things there's no debating is that if you want to bring inflation down, just cause a really bad recession. I've always I was very amused by Fed officials over the past couple of years saying, don't worry about inflation. If inflation makes a comeback, we have the tools to deal with it. And saying, what are you talking about? What tools? You've only got one thing that I know of, and that's to raise interest rates and cause a recession. Do you really want to do that? Do you really want to get to the point where you're so far behind the inflation curve that you've got to do a Volcker 2.0? They obviously don't want to do that. So I think, to your point, they got to be really happy with what just happened with Powell just indicating that maybe it's time to taper at a faster pace and watching the price of oil take a dive. And if they can jawbone it down, and if meanwhile time heals the supply chain disruptions, I mean, my forecast is that the inflation rate continues to hover between 4% and 5%, and it's already at 5%. So we're already at the top of my range. But it does that until the middle of 2022. And then I think it comes down to 3 to 4%. And then, to your point, it's like, so yes, so are they going to still say they want 2%? I think they might actually raise their target for inflation from 2 to 3% and said that's, 2% was too tight. We couldn't really get there, but 3% is more comfortable. We're not going to get in a position where we're hurting the labor markets. And so I think the Fed will raise the Fed funds rate twice in 2022 and raise the inflation target from 2 to 3%, so that they don't have to raise interest rates much more, recognizing that if they do, they might cause a recession. They might cause a real problem with compounding of the debt.
So as you think about that too, and so we're talking about now where we have kind of this, I'll call it the old school kind of inflationary environment, right, where it's 3 to 4% or so. Where do you put your forecast for kind of real GDP? Because from what we're seeing here, thinking about like a 4% type of growth rate, that puts us back in that what I call the old school nominal GDP growth of 7 to 8%, right? And that 7 to 8% is really healthy. That's a good way to grow your way out of the debt problems that Sam's referring to. And so How do you think about that, given that what we saw potential GDP and where we came out post GFC, right, was about 2.3% or so real? Do you think it's this technological boom that can be a catalyst for higher growth? Like, how are you thinking about those components of the real GDP side?
Yeah, economists, as a general rule, tend to be pretty depressing. They're always looking for trouble and forecasting trouble, and I think it has a lot to do with.
But they never forecast a recession, though, right? So
they never can. They always miss them.
Yeah.
But if you go back and look at Paul Samuelson's book on an introductory economics, which is what a lot of economists first studied, it says that economics is all about the optimal allocation of scarce resources, which is a very depressing concept. In other words, it's only so much, and we have to divvy it up as optimally as we possibly can.
It's kind of Malthusian, right? In some level, right? Yeah.
Some of us believe that the market can do that, and others believe that the government needs to do that. But what my real problem with that is, I think that economics is all about using technology to solve shortages. The market tells us there are shortages because the prices go up. That creates an incentive for entrepreneurs saying, you know what, I think I can make that product and service better at a lower price than is currently available. And it leads to productivity, leads to innovation. And so when I look at the outlook for the years ahead here, it's like we cannot grow with the labor force. The labor force is just not there. So if the labor force growth is demographically close to zero, we're not going to get any real GDP growth unless it's all productivity. And that's really my story, is I think we're going to have 4% productivity. That's 4% real GDP growth. And then on top of that, productivity should be consistent with low inflation. So we could have 2, maybe 3% inflation. And that gets you, 6-7% nominal GDP growth, which is high enough to help grow us out of some of this debt. But as you know, I constantly get asked, I'm sure you get asked, is like, how are we ever going to pay this debt off? And the answer is we never will. Hopefully we'll continue to prosper, get richer. And what you find is that when people prosper and get richer, their portfolios increase. And guess what? They want to buy some government bonds. I always find that to be interesting when I talk to some of our accounts who manage money for individuals, and they say, my accounts are very worried about fiscal and monetary policies. They're concerned that it's going to lead to all sorts of problems, and so they want to get out of stocks. So I said, so what do they want to get into instead? So, well, they want to get into government bonds. So wait a second. So they're complaining that the government's borrowing too much, and there's too many government bonds, but they want to buy government bonds because they want to be out of trouble, not face trouble. So prosperity is a wonderful thing.
Yeah. So one of the things you mentioned there is a question that you get all the time, and we do, you're right, we get it all the time as well, is how are we ever going to pay down this debt, this government debt? But I think that ranks number 2 on our list, Sherman, in terms of the questions that we get, because we're always getting nowadays, why own any fixed income at all is our first question. So yeah. Shifting gears here to the market, and perhaps giving us some of your outlook for 2022 and beyond, is kicking that off. What are your view on rates? Interest rates. We've talked about inflation. We've talked about GDP.
Yeah, I think we're going to get 2 rate increases, 25 basis points next year. I think the Fed will hesitate to do more than that next year, and then maybe in 2023 there might be two more rate hikes, and then ask me again. I mean, we'll see how that plays out. The bond market's been a real conundrum for all of us in the fixed income markets. The bond market made a lot of sense going from 0.5% back in August of 2020 up to 1.7% in March of 2021 of this year, because the economy was doing better. It was a V-shaped recovery. And so it made sense for the bond yield to go up, because the bond yield was anticipating that the Fed would at some point start to cut back on all this monetary easing. But meanwhile, the Fed just kept buying $120 billion in bonds every month, and including tips. And meanwhile, the Germans and Japanese are facing 0 to slightly negative bond yields. And that seems to have kept the bond yield from going any higher than 1.7. And for some bizarre reason, it started coming down and several weeks ago got down to 1.1% roughly. Why did that happen? Well, maybe it was the Delta variant. I mean, we just saw that the bond yield, which was again almost at 1.7%, came right back down to 1.4% or so on the latest variant of the virus. So, there on the equity side, there's been this mantra, TINA. There is no alternative to stocks, and the data shows that not everybody feels that way. There are actually people who are been buying bonds all along here. We've seen record inflows into bond mutual funds and bond ETFs on a 12-month smooth basis during the summer. So there are a lot of people out there who felt that stocks were overvalued and felt that they felt safer in bonds, even though they aren't yielding very much. I think the bond yield is going to go to 2.5%. I've kind of pulled back. I'm thinking it might go to 3%. I think there's some very powerful demographic forces. People are getting older, and older people tend to be more conservative and tend to rebalance out of equities and into bonds. I mean, in some ways, maybe the reason the bond market's done so well is because people have done so well on the equity side. They feel uncomfortable being so overweight equities and have been selling them, some of them, and buying back into the bond market. And of course, we've had the reach for yield, and so we've seen credit spreads come in very, very tightly. I think the Fed has demonstrated that they really are willing to come in big time and avoid credit crunches, which is really what used to create big spikes in credit quality spreads and cause recessions. And if the Fed is going to kind of backstop the markets that way, then I think we probably are going to see the credit spreads remain fairly tight. And what keeps bond yields down, even in the face of what certainly looks like a spike in inflation, is a perception that it's not going to be the 1970s all over again, and that bonds at these levels are, I don't know if they're attractive. I mean, let's face it, neither bonds or stocks are attractive in valuation terms, but there is no alternative to stocks or bonds for most people.
Yeah. So on that note too, one thing that you were kind of ignoring here is the rest of the world, right? We're talking about the U.S. here, and obviously the U.S. has had this prosperity post-COVID. We see NIPA profits just came out to new all-time highs, both real and nominal dollars. So as you think about it, is this the chance for your clients and allocators to be looking outside of the U.S. as well to try to look up some of these bargains? I mean, we looked at the gap between like forward-looking PEs on the MSCI World ex-US versus the US, and it's like a 6-point differential, which is some of the largest we've seen in history. So how are you thinking about that? Because as you say, there is no alternative, but there are other jurisdictions.
Yeah, no, that's very important. And I do that all the time as you do. Look at the world, not just at the US. And I do look at valuations on a comparative basis. I've been in the stay home camp since the beginning of this bull market, and stay home meant something different prior to the pandemic. I didn't mean stay home, stay locked down and hide under the bed. What I meant is overweight the US relative to the rest of the world. And that's continuing to work remarkably well. And part of the reason it's working so well is because, especially in the US stock market, we have a number of stocks. Well, it used to be 5, now it's 8, maybe it's 12. We have some of the world leaders in the technology. Not all of them are actually in the technology sector of the S&P 500. Amazon is consumer discretionary. Google and Facebook are communication services, and Netflix. But the thing is, we've got some world-class companies that have become $1 trillion market cap companies or more, And collectively, the Magnificent Five, as I like to call them, which some people call the FANGs, they're now 25% of the market cap of the S&P 500. If you add three more, do the Magnificent Eight, the largest market cap names, is something like 30%, and they have a 40 times forward PE. Take them out, and the S&P 500, instead of a multiple of 2022, has a multiple of about 18 to 19, which isn't a bargain, but it's better than what you have to pay for the really large cap growth names. Now, to your point, if you take the S&P 500 value, you'll find that its PE, it's been volatile the past few days, but let's say it's been around 16, 17. Okay. Now go overseas and look at the all country world ex-US MSCI, and guess what? You're going to get something like 14, 15. So you're not getting a great deal of a bargain going overseas when you can just stay home and buy value stocks if you're looking for relatively cheap PEs. But I think the US is still a world-class investment environment. We have a very diversified industrial base. We have some of the finest technology companies, biotech companies, healthcare companies, financial companies, and everything's becoming very tech oriented, which naturally leads to a higher valuation multiple. Now we talk about fintech and medtech. And so I think when I speak to our accounts and they ask me, okay, what are you recommending in terms of the way I look at my portfolio? I said, look at every stock and ask yourself, is that a technology stock? And look at me, are you nuts? You want me to put 100% of my portfolio in technology? I said, no. I want you to own technology, but I also want you to make sure that the companies you're investing in are using technology to increase their productivity and efficiency and provide better goods and services to their consumers. The Wall Street Journal recently had an article which was right in line with that and said, get rid of your IT department. You should no longer view IT as like a separate department. It should be integrated into everything you do in your business. Manufacturing companies have already done that. I mean, technology is integrated into manufacturing, and everybody's got to do that in the way they run their business. And so that's the way I'm looking at it.
So as we kind of wind this down a little bit too, we've covered a lot of the positive attributes out there. We'll try to be fair and balanced, as they say out there. What are some of the risks out there that you see that potentially others aren't really talking about? Obviously, the Omicron is new. We know Fed policy errors out there. What are some of the things that you see as potential pitfalls as allocators go into 2022?
Well, I think 2022 is going to be an interesting year. I guess they've all been interesting of late. But this clearly is this issue with inflation, the issue with the pandemic. You asked me about the global environment, and clearly China is an issue that people have thought about. Every time the Chinese Communist Party from the mainland sends a whole bunch of jets flying close to Taiwan, that should make us nervous, because one of these days they may decide this is it. That they may actually invade Taiwan. In Taiwan, and that would be a nightmare in all sorts of ways. But China itself has some really serious problems. It's, for a while there was a one-day panic attack over Evergrande, the property company that looked like it was going to blow up, and it's blowing up. They're just they're taking the air out slowly. They're deflating it, and so they have the authoritarian means there of managing some of these things, but that doesn't mean that they don't have a property bubble as bad or worse than what we had in 2007, 2008. That is not going to be, that could very well be a huge challenge for their economy. In any event, they're not going to get much growth from building apartments, given that they're trying to take the air out of that bubble. Then the other thing is their demography is horrible. In addition to what is happening across the world, which is urbanization leading to fertility rates below replacement. The Chinese also had the one-child policy, which they're desperately trying to move away from and encourage people to have more babies, but it's just not happening. And as a result, retail sales growth I've been monitoring has been falling dramatically. The growth rate's down to zero from about 18% in 2011. And I think it's all demographically related. The problem is with these demographic issues, how can a country that's basically becoming the world's largest nursing home aspire to be a global power? And that's the risk, is that they become militarily aggressive to offset the fact that they've got some real issues in their domestic demography and economy that they can't overcome. So China remains an issue. I think we got a Cold War already between China and the United States, and we're still doing a lot of trade with each other. But at some point, that may become more of an issue. But I think there's enough that we're all aware of to worry about, that you can't dismiss. You can't dismiss a wage price spiral. You can't dismiss the political partisanship that we're seeing in the U.S. kind of tearing at the fabric out of our country. But you read American history and you realize that we've always had issues with each other, and yet we continue to prosper together. That's really the heart of my message. Is like we really should try to calm down ideologically and kind of focus on what it takes to create prosperity and to build on that, to make people's lives better. And I think we still have a unique economy and a unique economic system. There's still a tremendous amount of the Shark Tank economy, if you will, or entrepreneurial economy, that's been the source of our prosperity. And I think that'll continue to be the case.
Yeah, there's been a lot of generations that have thought that they were the worst generation, that the future was bleak, it was dire. And I always like to say that, you can't fight the human spirit and ingenuity. That's what really drives us along, right? And so I think that's a great way to end it there too. Let's keep it on a positive tone, even though we're talking about risk. So Dr. Ed, it's been a pleasure, but before we let you leave, we got to introduce you to Sam's favorite part of the show. And you may recall this from before, but Sam, why don't you tell Dr. Ed what we plan on doing for the end?
All right. For the end, we come to my favorite part, which is Sherman Says, and that's where I will offer a series of alternating prompts between you and Jeff. Starting with Jeff first, I will give unrealized capital gains tax, I should say.
Does it really matter if it's capital or not? But yeah, no. So DOA, it's dead on arrival.
All right. 2% inflation target to Dr. Ed.
It wasn't achievable prior to the pandemic. Now they're overshooting it. I don't know that they're going to be able to get it back to 2%. So I think they're going to have to raise it to 3%.
All right.
When you can't achieve your objective, change your objective.
And your objective, exactly.
Yeah. Got those goalposts.
That's a pragmatic.
Income mobility.
Is that for me?
That's for Sherman.
Coming back.
All right.
That was a challenge in the post GFC era, and I feel like it's coming back. We're seeing like quits and everything.
Yeah, that's where you get it with the job switching mostly, right? Yep. Back to you, Dr. Ed, with stock buybacks.
I don't really have a problem with them. I think they're largely misunderstood. I think progressives really have an obsession about taxing them and limiting them. I don't think progressives, most of them, I don't know that any of them have ever run a business, so I don't know why progressives feel like that they can meddle in corporate finance matters. And a lot of the buybacks are actually related to stock compensation plans. And when you look at the overall S&P 500, you'll see that earnings per share really haven't grown much more than 1% per year faster than aggregate earnings. So it's like, wait a second, hundreds of billions of dollars of buybacks, and all we're doing in S&P 500 is a piddling 1% increase in earnings per share. So I think the whole thing is overrated.
All right. Sherman with Omicron.
I don't know. Just more noise. I hope it's not as bad as everybody says, but I don't know.
Yeah, it was interesting to see some of the explanation for the skipping of letters, though.
Yeah, you know, the old joke is that if you want to learn the Greek alphabet, you take probability and statistics, right? So, or you join a fraternity or sorority. But you know, most people are struggling to say the word, so it is Omicron. You know, so,
Omicron,
yeah,
or the new Z virus.
yeah.
Over to you, Dr. Ed, with wage price spiral.
It feels as though it's starting to spiral in that direction, which is why it's good that the Fed's getting concerned and starting to realize it's time to at least catch up with the inflation curve.
All right. Best workplace technology.
Virtual, what we're doing, Zoom, Teams, you know, WebEx, Citrix for those old school people out there, you know. So, you know, this is one of the biggest productivity increases we've seen, at least in the last few years on our desk.
Yeah, I would agree. All right, Dr. Ed, let me see here. Cryptocurrencies.
Digital tulips.
That's a great one. I haven't heard that description. I like that.
But let me explain. The tulip mania that occurred in Amsterdam occurred in Amsterdam. It was just one town, and at night they went to sleep. In digital tulips and Bitcoin and cryptocurrencies generally, this is a 24/7 market. And I don't know whether it's worth $60,000 or $1 million or zero. I don't have any way to value it because I don't have any, I'm not getting a dividend, I'm not getting earnings, I'm not getting anything that I can discount to get a present discounted value. I'm surprised that the central bankers haven't already squashed it because it's a competitive threat. But I do think pretty soon we're going to have bit dollars, bit euros, and bit yen, and more regulation that'll try to snuff out the cryptocurrencies, but I could be wrong.
Yeah, a lot to unwind there. Last one for each of you, different, unique ones, but for Sherman first with Santa Claus rally.
He delivers.
And Dr. Ed, for you, holiday sales.
I think when the data comes in for all the sales, it's going to be the best Christmas ever, because a lot of people have been scrambling to buy early before the inventories are out. So if it's not the best Christmas ever, it's because the shelves are empty.
All right. Well, thanks, Dr. Ed. That's a great overview. I want to encourage all of our listeners out there to seek out what Dr. Ed puts out there. His new book, In Praise of Profits, is on shelves soon. It's out there. So highly recommended reading. Definitely, talks about the prosperity in America, and it's a great page turner. So thanks for providing us with a copy of that, Dr. Ed.
Thanks, guys.
Yeah, and where can our listeners, catch up with you and follow you and stuff you put out there in the world?
They can go to our website, yardeni.com, YARDENI.com, and there's a 4-week trial on there. And then other than that, I post quite a bit on LinkedIn. I have my day job, which is what we have our clients for, and then my evening job is I really like to kind of download my brain for everything I've learned over the past 40 plus years. So lessons learned, and that's what I keep writing about.
All right. Well, we can all learn from our own mistakes and other people's as well. Sure. Hopefully it's other people's most of the time. So thanks again, Dr. Ed. It was a pleasure. Great to see you again. Best of luck as we go into 2022, and good luck with your book out there.
Thank you so much. Thanks, guys.
Okay. Take care.
Bye-bye.
Okay. Bye-bye.